All right, guys, welcome to episode 4. In today's podcast, segment 1, we'll be talking about mutual funds, bonds, index funds, stocks, commodities, and what they are. And then segment 2, Tony will be covering, and he'll be covering what you should invest in as a beginner. Make sure to use our affiliate links for Robinhood and Acorns.
Subscribe to the channel.
Subscribe, drop a like, leave a comment. And let's get right into it. So let's start off with ETFs. So an ETF basically contains assets such as stocks, bonds, stuff like that, commodities, and it's a passively managed fund that tracks an index basically. So this type of fund is basically, when you hear the term the market, that's what an like an S&P 500 ETF is. So this type of fund is tracking the market. It's not trying to beat the market. And this type of fund can be traded anytime during market hours from 9 a.m. to 4 p.m. So in ETF, you're getting diversification. You're getting a bunch of stocks all in one, basically. So it's a lot safer. Now, an index fund is basically the same thing as an ETF, with one major difference being it's traded after hours. So it's not, you can't like go on Robinhood and trade index funds. You can trade ETFs, which are exchange traded funds, but index funds are generally traded after hours. You can do it on certain apps, but I don't think you can do it on Robinhood at all. I think they just have ETFs. And then we have mutual funds. So index funds are technically considered mutual funds, but what mutual funds more commonly refer to when you hear the term mutual fund is it's managed by a portfolio manager, which is what actively managed means. So it's actively managed by a portfolio manager. It has stocks, bonds, precious golds and metals, international stocks. And the key term here is that the portfolio manager that is managing the mutual fund is trying to beat the market. So they're constantly swapping out stocks, international stocks, bonds. They're basically trying to beat the S&P 500 and get the highest rate of return for you. But the problem with this is that generally portfolio managers are not very good at beating the market. Generally, about 90% of the time, index funds and ETFs, which are passively managed, which means that someone is managing them, but they're not just changing out a bunch of stuff. They're just kind of doing it occasionally. So, and when they do it, the only reason somebody would take something out of an ETF was to try and say that because Tesla's going into the S&P 500 right now. So for the S&P 500 ETF, someone might throw in Tesla in there, because Tesla's now in there, but it's passively managed.
Yeah, we'll get the exact stat of mutual funds performance against the passively managed ETF, and we'll throw it up on the screen so we can give you the exact information of how many times they outperform. But I think that's it for ETFs, index funds, and mutual funds, right?
Yeah.
All right, so we're going to move on to segment 2, which is the one everybody wants to know. What should I be investing in as a beginner? Number 1, 401k. If you have a 401k through your job, use the 401k, get your employer match, free money. It's like bonus money. If you have a 401k and you want to invest on your own, if you're investing for long-term, because that's what we're about, is long-term growth. This isn't about day trading and trying to make a quick profit. We're giving you long-term information. So I picked out 5 funds that we recommend. These funds are consistent of bonds, real estate, the U.S. stock market, an international stock market, and a dividend fund that has high growth as well.
Do you want to just quickly mention what bonds are, since we didn't cover it, just really quickly?
Yeah, so bonds is basically you're loaning money to a company or a corporation. Usually it's mostly government, and they pay you back at a fixed interest rate, or they'll give you dividends just for holding the bond as well. So it's kind of a number one reason why people do it is for fixed income and to reduce volatility with stocks. So another thing that I forgot to mention is if you are an investor, you're going to want to invest in stocks and bonds. The general rule of thumb that most experts recommend is you take 100 and you subtract your age. So if I'm 33, say I'm 30, I subtract 100 from 30, that's 70. So 70% of my money should be allocated into stocks because I'm trying to make more of a return. And 30% should be in bonds. So when the market crashes, it helps stabilize it a little bit. Because bonds don't fluctuate that much. They don't go, there's not crazy volatility where one day it's up $100, one day it's down $100. It's pretty steady. So you're going to collect some nice income from it with dividends. And it's also a way to smooth out your retirement money. So you don't have to panic when there's a market crash. All right. So we covered that. The 5 ETFs that I'm recommending for everybody is number 1, a bond ETF. Vanguard Total Bond Market ETF, BND. The next one is the Vanguard U.S. Real Estate Fund, VNQ. Next one is the S&P 500 Fund for Vanguard, VOO. Next one is the Vanguard Total International Stock ETF, VXUS. The next one is the Schwab U.S. Dividend Equity ETF. That's your high growth and medium growth, high dividend, SCHD. Now, the one thing I'm going to say is you'll notice I picked almost all Vanguard funds and one Charles Schwab. That's because Vanguard has the lowest expense ratio, which I'll talk about in a second, and Schwab as well. And they're both two of the most reputable companies or brokerages around since the beginning of brokerages. So an expense ratio, VOO is 0.04, I believe. I'll double check that. We'll throw it on the screen. 0.04% per year expense ratio. What that means is for every $10,000 you have invested, you're going to pay $4 to Vanguard, which is nothing. Every year you pay $4.
Yeah, so stocks obviously don't have that fee.
Right.
But yeah, for ETFs, mutual funds, index funds, they all have that because there's somebody managing them. ETFs and index funds are lower because they're passively managed, whereas mutual funds, there's someone more actively doing it, so it costs more money, so the expense ratio is higher.
Right. So check out those 5. Do your research on them. I could tell you a million facts about them, but it's better for you to research it yourself so you feel comfortable investing your money into these funds. I have my money in these funds. I know Andrew has his money in some of these funds. So we believe in these funds. We've both done a lot of research on our own. So the last thing I'll say is if you don't want to invest in 5 funds and it's kind of a hassle and you don't want to have to deal with it, I'm going to give you 2 funds you can invest in right now, 2 ETFs. Vanguard Total Stock Market Fund, VT, stock ticker VT. This one has companies that are from the US, Japan, Hong Kong, United Kingdom, Canada, Switzerland, France, Germany, Australia, and Taiwan are the top 10 countries that have stocks in this holding. Excellent diversification. You have access to the entire stock market. So that's a good one to own if you don't want to have to bother with, buying a whole bunch of different ETFs. And then I would buy the BND Total Bond Market. So your entire stock market, entire bond market. And that's it.
Yep, that's it, guys. Oh, my phone just almost died. Yeah, that's it. So just make sure to, of course, something stupid happens. Of course, make sure to subscribe, drop a like, and that's pretty much it. We'll see you later. Peace.
And use our links below for the free Robinhood app and the Acorns $5.
Perfect.